Everyone, I'd like to call this special meeting of the High Point City Council to order. We have 3 items on the agenda today, and go ahead and get started here at City Hall. I am President. This is Mayor Jay Wagner. Also present is our Mayor Pro Tem Britt Moore, Councilman Chris Williams, Councilman Wesley Hudson, and Councilman Cyril Jefferson. I expect some of our other colleagues will trickle in as the meeting gets going. But let's go ahead and get started. There is a quorum present. First on the list is Bobby Fitzjohn, who's going to explain something about our finances. Something good.
It's great.
I'm sure about our finances.
You got it. Can you all see the presentation on your screens? Nope. So this will be a overview of the fiscal year 2021 financials, as well as just a quick update on where we're at through the first 4 months of this fiscal year. So to get started, here are the general fund revenues from 2021 compared to 2020. Overall, much better than what we imagined going into the 2021 budget season. If I could take you all kind of back to that time period, March, April, May of 2020, there was a lot of uncertainty about what COVID was going to bring. We were actually on a pretty tight lockdown in April of that year as we were working through the budget. Restaurants, a lot of retail was closed down. So just a lot of uncertainty and anxiety about how that would impact not only our citizens, but also the city's finances. The results are up there before you, and I'll just kind of go through them pretty quickly. So taxes is primarily property taxes. We actually saw about a 3% growth in Guilford County during this period, and it's actually it's the highest we've seen outside of a reval year in more than a decade. So we're kind of surprised by that number, and we're hopeful that means continued growth. We know there was a lot of downtown investment during this period, and some of that takes a year to get onto the tax rolls, and I think that's a lot of what you're seeing there, as well as the continued residential development throughout the city. We also saw about a 13% increase in registered motor vehicles property tax during that period, and so kind of one of many times we'll talk about how maybe increasing costs have driven tax revenues up. As supply tightened, demand increased on vehicles. As there was more money out there, we saw a lot of higher value vehicles, as well as a higher number of vehicles being sold in 2021. Intergovernmental services is primarily your sales taxes, your franchise taxes, utility taxes. So sales tax is where we thought we'd see the biggest hit when we put our 2021 budget together. We were being told 20% down year over year, and what we actually saw was about 13% increase in your typical sales tax. Outside of occupancy and utility and those other sales taxes, just goods and services sales tax was up about 13% in fiscal 21. License and permits really didn't take, not a lot of instability there. Charges for services remained about the same as 2020. That's where your parks and rec fees are. So you kind of saw the back end of fiscal year 20 where you had some reduced revenue, and the front end of fiscal year 21. We expect fiscal 22 to be much higher. The other number there is primarily the drop on that is investment income. It's going to be another thing we talked about a few times during this presentation, but we're back to near post-2009 investment income levels. As long as the Fed keeps the interest rate low, we just are in that situation where we're not expecting a really good return on our investments in the market. Overall, general fund expenditures remained approximately flat year to year. I do want to make a couple notes here. So general government, you see an increase that's primarily a lease for 911 equipment that's absorbed through the IT fund. Public safety, you see a decrease, but that is primarily because there were leases that were added in 2020, which increased the cost. And then we did have some CARES Act funding that helped cover some of our public safety expenses in fiscal 21, which brought down the burden on the general fund. Public services increase is primarily due to a timing issue on when they got started with the street resurfacing projects. Most of that was delayed until July of 2020, so most of the 2020 contract was delayed until really July of 2020, which was fiscal 21. So there's a slight timing issue there. Parks and Rec, lower programming expenses. We didn't have City Lake Pool open. So overall, lower programs and lower expenses related. But overall, the general fund saw about the same expenses as 2020. General fund balance, not really much to discuss until you get down to the assigned. You see that big jump. It's primarily appropriations for economic development from the Economic Development Fund. So it's money that was sitting aside for economic development. Some payments were delayed that we expected to kind of catch up in 2021. So there's no general fund appropriation for that. There was about $500,000 in actual general fund appropriation in this budget, which is part of that assigned number. The unassigned, which is, it sort of means there's no designated purpose at this point, increased by about $4 million. It's worth noting that that's about 13.6% of our fiscal year 22 expenditures. Our policy is to maintain a reserve of 10%, but I would just say we just got back into compliance with this policy in 2020. So we had a 2019 issue where we dipped below that 10%. 2021, we obviously outperformed budgeted revenues, which added to fund balance, but we're still only at about 13.5%. Any questions on that before we move on to the other funds? This is an overview of proprietary funds as a whole. This is your electric, water, sewer, stormwater, landfill, transit, and parking funds. Water, sewer, electric, stormwater, landfill, transit, fares, and parking fees are in that charges for services line. You'll see it stayed relatively consistent year over year. Utilities are always going to fluctuate based on demand, but overall we didn't see an issue where demand was greatly reduced in our utilities, so their operating revenues still kept up with our expectations. The big jump in intergovernmental is primarily related to the federal FTA grant that helps us operate our transit system. There was a delay in having the award approved in 2020, so we essentially have double the revenue in 2021, but all the expenses were back in 2020. But it certainly looks like we collected more from the chart. Proprietary fund operating expenses remained essentially flat overall during the year. Part of that is vacancies throughout the city. So salaries and wage expenditures were kept lower than the previous year. But overall, very flat, and nothing really kind of stands out there. On the cash and investment side, we increased our total cash by a little over $31.5 million from 2020 to 2021. This is primarily due to the working capital rebate that we received from electricities. You all may remember it was about $23 million, which we talked about during budget season as kind of completed our rate stabilization fund so that we could then turn around and reduce electric rates over time, which led to the 10% rate reduction in October of this year. So we're sitting on more cash than we were last year, but most of that has been put towards that purpose of the rate stabilization fund. Capital assets citywide, we continue to make investments. That construction in progress number decreasing is showing that we're completing projects, as we can roll them out into their fixed asset categories. But we continue to make investments in our infrastructure, our equipment, our buildings, and other improvements. One that you may not be entirely used to is the intangible assets. We'll talk about that a little bit later. But there's been some changing to leases and how we account for them. And so over time, you're going to start seeing that intangible asset number rise. And it's essentially the ability to utilize somebody else's asset, and that becomes an asset for us. And we'll talk about that more later. On our long-term liabilities, we did not issue new bonds in fiscal 21, so both the general and limited obligation bonds and revenue bonds decreased. I will mention compensated absences, even though maybe folks didn't have, that's primarily your vacation leave. So even though folks maybe didn't have as many options for travel and vacation, that number really didn't grow year over year, which is good. That was a concern that we had with maybe people wouldn't take vacation, but the number didn't really change too much. The biggest jump is on our pension liabilities. So LEOSA is the Law Enforcement Officer Special Separation Allowance, Elders is Local Government Employee Retirement System, and then OPEB is the post-employment benefits, so retiree health insurance. The city does not pay for retiree health insurance, but we allow retirees to participate, which creates a benefit to them and a liability for us. But overall, that's not the biggest piece in there. The reason for the increase isn't necessarily that we're underfunding our pensions. It's primarily that investment outcomes or assumed investment outcomes are coming down. So let's say instead of an 8% return, maybe we think it's more likely that we're gonna have a 7% return on these on the assets that are gonna pay for these liabilities. So that's where we're really seeing that increase, not necessarily that the system itself is getting more expensive or anything. And again, those liabilities are not those that the city will ever be asked to write a check for in any one year like you would debt service payments. Well, is there any questions about last year's financial outcomes before we get started on current year update? You all will have a copy of the annual comprehensive financial report by the time you have your next meeting. We had a printing issue that we have to address, and then we'll have a copy for you. And then the copy will be available online within the next couple days for further, if you need to review it further. Okay. So I wanted to walk you through kind of where we're at in our first 4 months of fiscal year 22. Above, you'll see a general fund summary. Really nothing to note other than the 40% of actual collections to date on revenue is completely normal for us. We have, in the general fund, we have a lot of revenues that are based on, not necessarily based on how much we've collected in any given month, but are based on more on the overall timeline of the fiscal year. So by December, we'll have about 95% of our property tax collected, at least through January we will. And then sales tax is delayed but comes in throughout the year. So it's not necessarily like we should have 33% of revenue. That's more accurate on the expenditure side, that we spent about a quarter of our estimated expenditures, or about a third of our estimated expenditures through the first 4 months. I do want to highlight sales tax because that's one of the more unstable revenues and more subject to the effects of COVID. And again, what we were really concerned about going into the 22 or the 21 budget. So if you see that, I think I can do this on the screen. If you see this red drop for May, which would essentially be what we collected in May of 2020 from April 2020 sales, this is about the last information we had before we put together the fiscal year 21 budget. And so we saw this, we saw the reports nationwide and thought we've got to lower our expectations. What actually came in 21 was about 13% higher on average for the entire year. There were a couple large refund months where you see these dips, but overall we outperformed our expectations and really had a pretty sizable return compared to any year in recent history. We are continuing that trend in fiscal 22. We're seeing at least 10% month over month or year over year growth in 2022. Obviously, the issue we have is that we only have 4 months of data at this point. We hope that keeps going, but it is an income that lags behind where we actually are in reality. And this is another view of that, just to kind of show that overall in fiscal 22, we're about where we should be compared to this point in our budget cycle. We're always in that about a third of the total revenue, or third of the total budget collected at this point. Water and sewer fund summary, again, nothing out of the ordinary here. I think what you're seeing is that we continue to have strong operating revenues for our utility system. Expenditures continue to be controlled, even as we may, incur higher costs for chemicals and other items that we have to order to maintain the system. If you look at fiscal year 21 actual, it looks, the variance looks a little different because we had a large planned PAYGO contribution in that year. About 15 million above what we usually put into PAYGO, and that was just part of our long-range capital plan to utilize dollars instead of debt. On the electric side, again, we continue to see pretty consistent results of where we expect to be. What you're missing in the expenses for October is the October wholesale power bill, which is about $9 million, which will bring the total expenses up to about a third of the year. The fiscal year 21 actuals, the variance there is that $23 million that we've already talked about, the working capital credit that was a unexpected revenue for the year. Mass Transit Fund, you'll notice again, there's a timing issue with revenue, so we don't expect to have the state and federal revenues in this early in the fiscal year. Those will come in much later. What you're seeing there is primarily fair revenue, advertising revenue, and just other miscellaneous revenues. On the expenditure side, salaries and wages are below a third of the budget, which is about where you expect them to be. They're not seeing the same issue on fuel as a percentage of their budgets. They did a little better, and we'll talk about that in a minute, in estimating their fuel costs, which is obviously a big one for transit. So overall, they're coming in really nicely on their budget. Parking fund. So this is a fund that's heavily subsidized by the general fund, and so you don't have the transfer in on the revenue side, and you don't have some of the capital that they plan to spend on the expenditure side. Last year was a good year for the parking fund, which, during a pandemic is great, but I think the market attendance and everything still kept those parking decks up. They also delayed some capital spending that was budgeted, so that $223,000 net variance is really, some of that will be used in the current fiscal year for some capital they're working on. On the solid waste side, this is completely in line with prior years, up to date. Nothing really exciting on that one. Stormwater Fund, again, revenues are in line with where we want them to be. On the expenditure side, a lot of that budget is related to debt service payments, which just haven't come due yet, so it's not really fair to think that they would have spent, a third of their budget at this point. Their fiscal year 21 results were strong, primarily related to lower expenditures than budgeted. So a few discussion points I want to hit before you all may have questions. Operating revenues in the current fiscal year continue to be strong. Water, sewer, fees, electric, up until the rate cut. We're going to see how that changes things once those October bills come in. But we're still seeing strong revenues. We're still seeing strong sales tax, property tax. Everything is lining up to be a good year. That said, we're only looking at 4 months, and there's still a lot of year left. Primarily on the expenditure side, there's some concerns there. Interest income, I mentioned it earlier, we're back to post-2009 levels, where even though you've seen the size of our portfolio, we're looking at $1 million a year in revenue compared to the $5 or $4.5 million that we were seeing in 2019 and 2020. And down to the economic pressures. From conferences I've been to, economists are predicting at different points that the Fed's going to start raising interest rates, which is really when we'll start seeing higher rates on our investments. Other economic pressures, fuel is much higher than it was when we put this budget together. There are some departments that are approaching 50% fuel expenditures through October. So we'll be working with them, and we may have to come up with a comprehensive strategy depending on where fuel prices continue to go on how we address the citywide. But we're working with the individual departments at this point. Other pressures are anything with precious metals is getting more expensive, and the lead time is being extended. So primarily the electric department's feeling that. Chemicals are going up, and water sewer is feeling that pressure. But really, citywide, anywhere there's chemicals, precious metals, or a lot of anything that's really imported, we're seeing higher lead times and higher costs. Right now, we're able to absorb that, but there are certainly deliveries on the horizon, which, when they come in 6 months from now, we can't say that they're going to honor the price of when we ordered it. There's a lot that they have with the force de jour, I believe is the fun legal term, that lets them out of that. And they can't be forced to sell something that's going to, bankrupt them. So that's where we're running into a lot of issues on the precious metals and some of the wires and things that we're ordering from electric. There's a lot of uncertainty about what it'll actually cost us going forward. Otherwise, there's a new GASB standard coming out around leases. We've talked about it a little bit, where some equipment leases we've started treating those as assets, and the equipment, the lease payments are treated as debt payments. It's essentially going to become that all leases, other than very few exceptions, are going to go onto our books as both assets and liabilities. What that's going to mean is you're going to see me up here more with budget amendments, because we have to treat them like the issuance of debt and the expenditure of a capital every single time we enter into a lease. So we'll keep you all updated on that as that change happens. Any questions about where we are in the current year or the prior year results? The auditors will be here this afternoon to present just really the audit and go through the process of what they did and the results at that point. Okay.
Thank you, Bobby. Okay. So since we started the meeting, for those listening online, Councilman Vic Jones is now with us, and we'll go to the second item on our agenda. And for that, I'll turn it over to the city manager to talk about some city-owned property in the Washington Street Cultural Arts Museum.
Thank you, Mayor. For those of us that might be listening online, this is Tasha Logan Ford, and there is a map that has been placed at your seat. In, I do believe it was July, we first had some conversations around identifying the ownership of property along Washington Street, really in between University and Gordon. There's property that was, a resident had a special interest to build a cultural arts museum on this site. Once we got into doing the research on the property, there are a portion of the lots that are owned by the city, and a portion of the lots are owned by the Housing Authority. The portion of the lots that are owned by the city, on your map, they're highlighted in the yellow area. The largest lot that's closest to the corner as you are approaching the Gordon Street intersection, we currently use that area for storing debris and different materials there, so that is not a site that would be eligible for us to dispose of at this time. The property that is available is just outlined in yellow, and it represents just over an acre of property that the city has available. Last week, we were able to meet with Ms. Bridges and with representatives from Samet about the Cultural Arts Museum and really try to get an idea of how much space would be needed for that project to work. And, clearly they would need pretty much the whole block to make the area work. The acre that the city has available is not sufficient to meet their needs, but they would like to continue having conversations with the city and also with the Housing Authority to see if there's some options for us to be able to work out use of this site. If we're not able to get there, then there are some other alternative sites that they have in mind, but at this point, they're not willing to completely abandon this location until we have some additional conversations. But the commitment was for our legal team to provide the ownership information, which that has been done. We identified what was under the city's ownership and what was not, and we have provided that information to Ms. Bridges and Samet. So at this time, they've just asked us to give them some time to evaluate their options, and then they would come back and have conversations with staff at a later date. I'm happy to address questions that council may have.
Tasha, this is Councilman Moore. Did they answer the question about how much land they thought they needed to build what they wanted?
Well, it depends on the site and how much parking might be available. If they were able to identify parking in another location, or if it was adjacent to some other public facility where they could accommodate parking, that changes how much area might be needed. I think ideally they're looking for somewhere around 3 to 4 acres, but it could change.
Thank you.
Mm-hmm. Yes, sir.
Anyone else? Okay. Thank you. Next on the agenda, we have an item, we have a couple of items that require closed session for attorney-client privilege and for purposes of economic development. I will need a motion to go into closed session.
So moved.
Okay, there's a motion made by Councilman Jefferson to go into closed session, seconded by Councilman Chris Williams. Is there any discussion on the motion? Okay, hearing none, all those in favor of going into closed session, please signify by saying aye. Is there anyone opposed? That motion passes. And as soon as the room is cleared of folks, we'll go into closed session. Okay. Yeah, all right.